Friday's sell-off was sharp and aggressive. The Nasdaq plunged 4.2% in a single session, forcing a difficult question about the horizon, whether this is a contained event or the first crack in a total market reversal. Uncertainty makes us deeply uncomfortable, so as a biological reflex, we look for causes and patterns. When we don't know why something happened, we invent a story to make sense of it. We've been doing this for centuries. Take the historical myth of wind eggs. For hundreds of years, people actually believed pregnancies were caused by the wind. The theory was obviously wrong, but it solved a problem. People demanded a causal explanation, so they created one out of thin air. The modern financial media operates on that exact same instinct. Before a weekend market drop has even finished, commentators have already attached a dozen unproven causes to it, blaming tariffs, interest rates, or AI spending. History shows that markets usually move first, and the explanations arrive shortly afterwards. But beneath the noise of those instantly generated headlines lies the true anxiety driving the panic, the dread of repeating a specific piece of history. That historical phantom haunting current investors is the 2000 tech wreck. It was a terrifying period for anyone holding stocks at the time. The bursting of the dot-com bubble erased 77% of the Nasdaq's value from its peak. It took 15 agonizing years just to reach its previous high. To determine if we are actually facing a second tech wreck, we need to diagnose the exact difference between the assets people were buying back then and the assets traded today. The 2000 market was defined by euphoric buying. Investors threw cash at any stock with a dot-com in its name, even though many of these internet companies had little to no revenue and absolutely zero profits. Valuations completely detached from reality. Prices were based entirely on what a company might possibly do in the future, rather than what it was actually earning at the time. People were paying massive premiums to buy pure dreams, and that made their portfolios structurally fragile. Because the underlying assets lacked actual value, the resulting crash caused permanent losses, driving those companies straight to zero. Compare that to today's tech leaders. Companies like Nvidia, Microsoft, Alphabet, Meta, and Amazon completely dominate global markets. Unlike the fragile startups of the year 2000, these modern giants generate massive real cash flow and record-breaking profits. This creates a critical distinction between expensive and worthless. While today's market may be priced high, those prices are backed by actual mountains of cash. Expensive assets can and do become temporarily cheaper during a sell-off, but they do not evaporate into nothingness the way the dreams of the dot-com era did. Once you recognize that the underlying value is real, you can view market corrections for what they actually are: inevitable, natural events, as predictable as rain or wind. This chart of the S&P 500 from 1998 to 2014 illustrates how frightening declines happen without destroying the market. Looking at the red arrows marking the peaks and the severe pullbacks that followed, they looked disastrous, yet all eventually recovered. The data reveals a consistent pattern. Massive sudden declines routinely occur without ending the primary upward trend. Large, terrifying drops do not automatically guarantee a structural collapse. They are historically proven to be a normal feature of a healthy, functioning market. Navigating this kind of volatility requires looking past the surface. It requires separating the crashing wave from the movement of the tide. A wave is a dramatic, disruptive event on the surface. It commands your immediate attention and can certainly knock you over, but the damage it causes is ultimately temporary. The tide, however, is the larger underlying current beneath the surface. It is what actually dictates the true long-term direction of the economic environment. A sharp market sell-off is almost always just a wave. But to be sure, investors need an objective tool to confirm that the tide itself hasn't turned against them. This is where the ITM Sanity Checklist comes in. It's a factual diagnostic toolkit designed to cut through the emotional panic when a massive wave hits. You ask 4 specific questions. First, are corporate earnings collapsing? Second, is unemployment surging? Third, are consumers retreating? And finally, are businesses actively cutting their investments? If the answers to these 4 questions remain no, then the sell-off represents a surface-level wave rather than a shift in the underlying tide. The primary trend is likely still intact. Nobody knows if a Friday decline will end tomorrow or last for weeks. But because today's market is anchored by the most profitable companies in history rather than empty promises, a dramatic drop does not automatically mean the tide has turned.